Hello YouTube! Today the FOMC and Jerome Powell spoke. They moved the market and we have to really pay attention to what is happening on the charts right now. We can note that we are now currently at the low of the week. We have fallen below our green line at 380.54. We've lost our uptrend. We have increasing bear volume. This is looking progressively more bearish. Why? The FOMC pulls off a slightly hawkish surprise. We're going to talk about exactly what this means, what to do on the charts, what this means for our weekly perspective. We're also going to talk about how there was an hourly setup we were watching really close, how we actually had a short-term bearish pattern or a head and shoulders. We met an apex and we flushed all the way down. So there is a lot to go through today. I'll do my best to try to summarize it in as brief of a video as I need to, but please smash a thumbs up. Drop me a comment if you enjoy the commentary. I always enjoy all of your comments. So the first place I want to start is by just talking about this 380.54, which I talked about as being a key level of support. What we did is multiple times we found buyers at that support area, once, twice, and then on the third time, the buyers were just exhausted and we went lower. It's that simple. The message and takeaway from Jerome is a little bit less important than just the pure feedback we're getting here. We got a bearish engulfing candle after we have that same thing on the weekly. But what I want to note is if the bulls are going to make a comeback, it pretty much has to be right here, right now. And I say that because this 380.54 area is going to be different for ES. If you look at where this level comes from, we're now going to jump over here to the E-mini futures and note that, it's actually 3807.5. So we did actually break 3800 to 3799.5. But all this means is that, yes, we can look at a different chart if we still want to find that bullish story, and it is there. There is a violation. Is it going to turn into more? I'm not entirely sure. But this 3807.5 area is going to be very, very, very important. I also want to talk about the psychology of how we can actually get best prepared for this. So if we go back here to our daily chart, we knew what we were expecting. We were expecting more pain. Jerome delivered what the market would have wanted, and now we're going to start moving forward. What's so interesting about this is that we did the opposite of what we have done since March. So during FOMC meetings, here's what the market has done on average. On average, the day before, we're up by 0.6. The Fed decision day, we're up by 2.3. The next day, we puke it up. What did we do so far? Red. More red, right? Fat red. 1.7 red. What are we going to do tomorrow? Well, if we've done the opposite for the last two here, is there a bull case for us to go up? It's looking a little bit more bleak, but sure, we could do that, maybe. What I'm also looking at here is what the dollar actually did to impact the move on SPY. So the dollar's up by 1%, and we note that SPY is down by 1.7. So only really about 0.75% are attributed to the SPY move. We got about $1 in pressure from the DXY, which just continues to crush it, right? It's booming. It is bullish, and people want to buy it. They want to own it. They want to store it. They just love it. We can also note that we have, increasing bearish volume as we go lower, but now we're actually flatlining. So the volume is telling us something here on the daily, but also on the shorter time frame. We're now going to move forward to, if we've done the opposite, the bull case for tomorrow is, well, we pretty much have to go big pumps starting first thing tomorrow. We have to get above 380, and we have to start reclaiming areas. So an easier way for us to look at this is by just looking here at the support and resistance levels, where right now the printed close is 377.45, which means we're in between S2 and S3. We actually have a really cool feature that we've launched here on our app platform, and I think this might be a really great time for us to look through that because we're trying to think about a football, and if we have a football and the S&P is currently moving, well, this is what it looks like right now. So this is from our platform. You can click on the link in the description if you want to find out more about that. But as of right now, we are inside enemy territory, which means that this should be red. We're currently close to scoring a bearish touchdown. If we lose 372, oh boy, that is going to hurt. So we're looking pretty soft here. And I can understand why we're currently here on the chart. If we now look forward to the next thing I want to look at here, I want to focus on a little bit less of what actually moved, but were there any changes in what we heard from the Fed? And this is so important because We have to remember the trend is your friend. And when the trend is down on the daily, on the weekly, on the monthly, below 395, what are we? If we're bullish, we are fish swimming upstream. We should not be surprised that there is pain. We should not be surprised that there is resistance. Are we? Probably. I think a lot of people might have dived in head first when they got that false breakout, and they're really regretting it. So please remember, we are fish swimming upstream if we are expecting this to be a bearish continuation. Moving forward, so if we now think about, I'm trying to think about, well, what did Jerome actually say? And was there really a surprise here? This is what I heard. I heard that we're going into a new regime. The regime was, I don't know, about a year ago, Jerome was largely talking about a soft landing, right? Soft landing. Now then he talked about softish. And then we got a tease out of pain. So what would be next? Is that recession? He's not going to say the word because people are going to start pointing the finger and saying, Jerome's going to self-fulfill and create us a recession. I don't know, but I think that if you learn how to read between the lines, he is saying exactly what I have been talking about. He is smarter, he is more articulate, and frankly, he's better looking. So I think that I'm hearing what he's telling me. I think the market heard what he said today too. The other thing I heard was that we have to go higher for longer. And for reals this time, right? Pinky promise, double tap, blah, 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 right? This time we're really doing it. So if we look here at the key dates, we look at the dotted line here, which is December, March, and June. So December, up, up, up. What should the market have done? Well, down, down, down. And isn't that exactly what it did? If we look here on the chart, we're going to delete everything. All right, so now we're going to look here to December. Oh my goodness. What? That's where the market topped? Whoa. Well, what about the next time? Where am I here? Where is my screenshot? Here we go. Let's move it a little bit closer. So December. Oh, wow. That is when the market went down, down, down. Yes, because of as these lines go up, the market should go down, down, down. So up, up, up. We go down, down, down. We actually go down by about, what's the move here? It's about 12%, 13%. Okay. Then we look at March. Okay, in March, where were we? Oh, right here at the end of March. Yes, sir. So then we went down by -20. Oh, well, the Elliott wave technicians are going to tell us that the waves predicted it. No, they're just giving you the feedback from what happened in terms of the pivot. So now we hear that up, up, flat. Yeah, we're not actually going to go up, up, down. And man, where there was the mistake or the repricing in the market was in June. Why? June line tells us that up, up, down. The bulls rejoice. They cheer. Jerome did it. Recession over. Inflation's canceled. Wait, it's not. So then we go up by 20. And now right here, right now, as I did on the weekend video, the stage is set for us to go one way or the other. So if we understand the significance of this change, this is what Jerome said today. I'm not going to go through and provide quotes. I'm just going to tell you what I think. I heard what I laid on the weekend. Up and flat. So I think that they're going to go up into here, a little bit higher into 2023, and then higher. Because what Jerome kept referring to was the summary of economic projections, which we will try to look at. So I heard higher than currently priced in, roughly where the market was, and then longer. And we actually had the terminal rate come down from 4.6 to 4.4, which just means that, as Jerome spoke, we actually lowered those expectations a little bit. But this is what we're currently looking at. Second thing I would note is that Jerome also said that we're now just starting to enter the area of restrictedness. Where did we get to? We got to 3%. So what Jerome is saying is that we've now just poked into the restrictive area, right? 3% would be considered restrictive if our target is 2. So what he's saying is we're entering the area where we are currently restrictive, and we will go higher. Up to where? Roughly 4.6. And I'll show you the reason why. So right now, what the market's pricing in is just more than what was there before. Into 2022, we're going to be, well, right now we're at 3. We're probably going to go up to like close to 4 into the new year, a couple more hikes into there, and then flat. That's how we get that repricing. So if up, up, up made us go down, up, up, flat made us tank, up, up, down made us go down, make us go back up for the market. What happens now when we get up, 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 and then for longer? Whoa, well, that's kind of like blending these two lines together, the yellow one and the red one. And what were those? Those were the nastiest shocks to the market. Oh my goodness, did those hurt. That was here in December and then here in March, which led to what? -10 and negative, I don't know, -25, -20. That leg lower was about -20. So there's our -10, there's our -20. Do we get a -30? Can I get a 30? Can I get a 30? Can I get a 30? I don't know. But that's what happened today. If you're unsure, it's just that simple. We're fish swimming upstream. The path is going to get harder. There is still a path to a soft landing, but even Jerome said that path is narrow. I would not count on it. Slightly hawkish surprise. 5 key takeaways. This is really going to give us the meat and potatoes of what happened today. The Fed raises its main rate. We already know that. While new projections from officials show a median estimate of 4.4 at the end of 2022 and 4.6 at the end of 2023, which just means we're going to go up to roughly 4.4 from that screenshot I just showed you. Let me show it again here one more time just to make sure it's clear. This one here. So up to 4.4 and then a little bit higher to 4.6. Then we're gonna stabilize. That's what it means. So I'll show it here one more time. Let me make sure the recording's actually going. Yeah, it still is. Perfect. So we need to go up to about 4.4, a little bit higher to 4.6, and then flatten out. That's way more than what's currently priced in. Last time in June, we were pricing this. So this differential is what the market's currently pricing in. That's simple. That's the first takeaway. Second takeaway is that decision was unanimous. The dot plot shows 10-9 majority in favor of hiking above 425 this year, suggesting a fourth straight 75 basis point in November. Cool. Policymakers expect rates to be cut in 2024 to about 3.9 and 2.9 in 2025. So we're still pricing in cuts, but those don't start until next year. Higher for longer. Statement is virtually identical to prior FOMC in July. Fed says recent indicators point to a modest growth. They're basically calling for a recession, a soft recession. They're not going to call it that though. Again, soft to softish to pain to, oh my God, recession happened. Oh no. GDP growth forecast marked down to 1.2 in 2023 and 1.7 in 2024. This is stagflation. I know what they're saying. All right, so here is the summary of economic projections. I think we'll leave the link in the description for you if you want to go read it, but they're saying that in the previous article, this is unchanged, which means that what they laid out in June, which made us go big time down, and what they wanted, was for us to go big time down, and Jerome Powell reiterated, go back and listen to Jackson Hole, which is where I told you what happened and what's going to happen. The market is starting to price it in. The numbers we saw for unemployment, for GDP, and everything else can be found on this sheet right here. This is the SEP, or the Summary of Economic Projections. I'm not going to pretend that I am a Fed analyst. All I'm going to do is tell you to look at a few numbers here. We're looking at this column right here. So we're looking at the June projection, which will be found on every single one of these items, and then we get the revised number. All I want to look at is going to be what we were pricing in for June versus now. We looked at the numbers already, by the way. So real change in GDP, 1.7 to 1.2 this year. That's a pretty big tick down. We look down to the next column here. We look at unemployment. We're now going to go to 4.4, right? Oh, that's right. Anything below 5% is considered full employment. The Fed is now saying we're willing to tolerate a 4.4% unemployment rate. Those job numbers are going to really matter, and they're still mega strong right now. And then the last one here is core inflation. Went from 2.7 to 3.1. I still think that is far too low, but they're not going to go from 2.7 to like 8. They're still going to try to navigate that soft landing, even if it looks less likely. Here are the numbers that really stick out to me as well. So core PCE for next year is at 3 to 3.4. And no surprise, that is what we're going to be, again, expecting for next year when they start to moderate the rate of increase. Last number here is going to be the federal funds rate. And this is basically the dot plot. So these numbers right here show that we're now going to be at a Fed funds rate in 2022 of 4.4, 4.6 next year, and then 3.9 in 2024, 2.9 in the longer term. This is assuming the Fed's projections are correct, which, by the way, up until now, they have not been. They are revising in hindsight that they were wrong. So there's still a lot of rosiness baked into these numbers. We'll find out what the market reaction is tomorrow, and people are going to vote. They're going to buy or they're going to sell. I'd also remind people that today Jerome Powell spoke. If the message he wanted to be received we're probably going to be hovering around here into Friday. If on Friday at 2 o'clock he is unhappy with the post-FOMC meeting today into Friday reaction, meaning if he wants stonks go down, he's going to come out and tell you, stonks go down. You misheard what I said. You need to reprice. We need to go lower. If on the flip side, he tells us that we're actually able to navigate better than what we thought and you communicated on Wednesday, meaning time to go back up, whoop, 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 whoop. He'll tell us that on Friday too. And this will be so important because our weekly candle close is going to happen 2 weeks after Jerome speaks. So Jerome Powell is going to speak. 2 hours later, we're going to close out the week. And then we got the core PCE the following Friday. Why does this matter? Well, if you remember, we were talking about this on Monday where I said, right now, the weekly candle is right here at the high of the week, which means we got an inside bar, we got a higher high, we got a higher low. But if we get a negative reaction to the Fed, this will look like an inverted hammer after that. That's exactly what this is. And where did we reject? The previous weekly low, 388, the high here, 389.31. We moved 10 points today, 388.42. We basically tested the last 2 weekly lows. Those are now resistance. Last week's close, resistance. Last week's low, resistance. This week's open, resistance. Everything is now resistance, which means we are those fish swimming upstream. We need to be aware of it. Why bull or bear? Shallow recession, I don't know. That looks a lot less likely now. Probably going to have to scratch that one out. We got the bear case strong, super strong. Surprises, bearish, confirmation bearish. So the question is, was it already priced in enough? Do we need to reprice more? I don't know. SEP, I saw what I wanted. Powell speaks twice. We'll hear what the reaction is tomorrow for the rest of the world in the feedback loop. And then we'll see what Jerome clarifies on Friday. And then we got the big bad earnings season, which a lot of people are watching closely, myself included. Bear market targets. So since we're making fresh lows, we have to watch for the psychological areas. I'm watching 372, as we noted here from our weekly levels, from my weekly level, sorry. So I'm watching, now that we lost 380, I'm watching for 372, and then I'm watching for 364, which is our 2021 low. And then we're watching for 362, our current year low, and then 350. Yay, 350. To put this all together and make it a little bit easier, as a reminder, we went through my notes on the weekend. I showed them yesterday, showed them on Monday, I believe. And this is very easy for me. This is like a cheat card for me, right? I'm going to class. I got my cheat card. Perfect. Higher highs on interest rates when global debt and economy cannot handle what is needed to get us to 2%. And I heard Bloomberg actually talking about this today. We need a new mandate for higher inflation, meaning more than 2%. Or Jerome said he's going to keep moving until something breaks. That's what I heard him say today. Fed plans to use both tools, interest rates and balance sheet. He basically said the same thing today. There are no planned changes to the balance sheet. Interest rates, right, TBD. 2008, we're one sector, one country. We're seeing a lot more devastation right now. Geopolitical risk, I don't want to get into it. You guys know it's elevated in the short and medium term. The TA, 2008 and 2022 parallel. So far, looking a lot more likely than not. Algo says invest in being short. Check. Those are easy dollars. Going short, that's a hard penny. We have not printed a higher weekly high. We got an inside bar breaking bear. So as of right now, bears are notching more evidence. So bullish engulfing, bearish engulfing, lower high, lower low, massive stomp. Massive. So that's a hard penny for, it's a hard penny for bulls. Easy dollar for the bulls. And yeah, I saw a lot of commentary today and yesterday. Oh my God, we just have to cool off for the next big rally, Justin. We got it already, right? We're already down by 10. I know we're down by 10. Trust me, I know. We went from 432 to where we are now. We're down by 12, actually. Yes, the cuts are getting nasty. They are getting more deep, and people are really noticing that. So what happened today? Well, pretty much red everywhere. What I want to do instead is zoom out to the weekly and then to the monthly to see, Tesla green, right? Little pockets of green, but the theme is clearly red. Tesla green in the last 30 days too. Tesla is unusual. It is holding up. Apple starting to fall. And I'm going to show one last thing here, and that is going to be the options for this week. It's still almost 50-50. There was an oversized order that came in today for Tesla at $100 million for 353 for basically this time next year. That's a big fat order if someone's really bullish. There's also some puts that were bought, I think, at 200 for that same expiry, but it was not unusual, so we did not log that one. Otherwise, big orders are SPX. Then we get some big orders here that are bear too. What I want to look at instead is going to be the flow for today, meaning what did people position going into Jerome and then post Jerome? Oh my goodness. Yeah, big orders today. 60% puts, 40% calls. WTF, right? That's what I'm hearing. Bearish flow, though, overall for today and on the week, marginally. So the video's already quite long. What I wanted to do was to give you the insight in terms of what I saw happening, seeing how our playbook is starting to materialize. I want to look at a couple more things just really fast to wind this out. QQQ or the Qs. Inverted hammer, lower low, looks bearish. We're throttling that negative 30. So S&P is now back inside bear market territory by being below 384. And if QQQ falls back below 283, which it is right now, 279, or roughly another 1.5%, will be below 30. Probably going to drag S&P even more down. We've lost our uptrends. The waterfall is starting. Dollar is even higher. It's ripping. It's roaring. It is bullish. VIX up 3%, but not inside the elevated pocket quite yet. Also note, VIX over 25 means a 1.25% daily move is implied, not guaranteed. What do we move today? 1.7. Yep. So market's just acting normal. It's doing what we would expect. 2-year note, absolutely crushing it over 4. 10-year note, crushing it over 3.5, but right on the day. What does that mean? Short-term inflation expectations are rising. We're baking in cuts into 2024 and 2025. It also confirms it here. Inversion is up, which means recession risks are higher. This would be our second strongest weekly close ever, if this holds. Gold holding up also tells me a massive signal. We know, again, I know, I'm looking at a mega bullish pattern in the longer term. I don't know if it's materializing now. Massive pot and handle, has to push off the 200. This tells me the same thing. People would rather have something boring but predictable than have that hot flying Bitcoin or Ether, which is breaking down, currently below 2018 and 2017 highs at 19.8 and 14.24 Ether. Otherwise, everything's pretty much red. It's a matter of how red. ETFs are all red. And I went through this on the weekend. So if you enjoyed today's video, please smash a thumbs up, drop me a comment. And if you want to see more analysis, I encourage you to click on the video that'll come up here now, where I go through and explain my weekend thoughts in terms of how we might have landed here, and now that we are maybe seeing how in replay or a postmortem, that we actually got here. Thank you for watching. Look forward to seeing you tomorrow.